Hey, good afternoon, everyone. Thank you very, very much for being here with us today. I'm Pratibha. I head the Managed Investments and Advisory business for EMEA and Standard Chartered. Thank you all for being with us for what I think is a very timely and an important conversation. The situation unfolding across the Middle East is one that many of our clients are watching closely, and rightly so. Geopolitical events of this scale don't just make headlines, they move markets, shift capital flows, and raise real questions on how portfolios should be positioned. Our foremost priority, of course, continues to remain the safety and well being of you, your families, businesses, our employees, and we continue to be fully committed to supporting each one of you during this period. From our perspective and at Standard Chartered, what matters most in times such as these is to help you stay informed and well positioned in your investment decisions. So, today's session, we will share our latest views as always, explore the implications of all the developments in the markets, and align them to how you should look at it from your portfolio's perspective. We're joined today live by Manpreet Gill, our Chief Investment Officer, who a lot of you are already very, very familiar with. And we are also joined by Sandeep Kantori, who's our Chief Investment Officer for Equities at Standard Chartered and who is based out of Singapore, joining us today, who both together will take us through their views and thought process. I encourage you to submit your questions via the Q&A button, and we will aim to address as many as possible in the next hour or so. Thank you again for being with us, and without further ado, I think we'll get on with our session. So Manpreet, thank you again for being here with us today. And as always, we've started out of these webinars with, discussing the ongoing situation. And, with this conflict entering the 6th week, and with all the developments in the last 24 hours, with a 2-week ceasefire in place, your base case seems to have played out. Could you maybe walk us through the scenarios and how they are expected to evolve going forward?
Thanks, Pratibha, and good afternoon, everyone. You're absolutely right. I think when we were having this discussion yesterday, it felt like we were at a particularly pivotal moment, but we had quite a bit happen overnight. And as we've been advising ourselves, right, we always had a framework of our base case scenario and a downside scenario. So that, of course, made it easier to take all that incoming information and sort of see which way it appears to be pointing. And you're right. I think while 24 hours ago, things look a little bit more concerning, but given where we are today, it does look like events are proceeding largely along our base case scenario. And recall, our base case scenario was we put around a 70% probability that the conflict and hence the resulting rise in oil prices would be 4 to 6 weeks long, as opposed to several months long. So obviously, two very different impacts on global growth and global inflation. So I think the ceasefire itself, it does seem to fit a base case, and maybe just by the skin of one's teeth, just before the end of 6 weeks. But obviously now we are at a different sort of pivotal point, because a ceasefire does improve the outlook, arguably, for the next couple of weeks. But the focus shifts very much now to the negotiation process, because a relapse or a failure of the negotiation, a relapse to any kind of military conflict, obviously would be quite problematic, and revive talks of the downside scenario. But I think if we do see positive signs of the ceasefire moving to some sort of longer lasting agreement, that would, of course, give us greater confidence in that base case scenario, which is one where that rise in oil prices, of course, is not long lasting into several months. And recall, we're particularly fixated on that point because when you think about the channel and impact to global markets, right? Short period of oil prices may be more manageable from an inflation shock perspective, from a growth shock perspective for emerging markets, which are key energy importers. But obviously, prices that stay high for a prolonged period lasting to several months, that starts to increase downside risks. And I think the fact that we've got here in a matter of weeks is, I think, part of why we're seeing, the positive market reaction that we are today.
Thank you, Manpreet. Maybe let me just jump over to Sandeep. And firstly, thank you very much for being here with us today, Sandeep. Just from the latest developments, oil is down 19%, stocks are surging. Where does the biggest catch-up trade happen in equities, and how should clients think about rotating their portfolios in the next 2 to 4 weeks as this plays out?
Yeah, thanks, Pratibha, and good afternoon, everyone. I mean, to be fair, actually, I must say, compared to the more tail risk indicators like VIX or even oil prices, actually, equity markets have behaved much better, right? So when I look at global equities versus any of the previous escalations, I must say, I mean, even I exclude last 3 4 days. I think markets. Uh, to answer your question on catch-up rate, I don't think in the first place we have seen a massive drawdown. Yes, there are certain segments. So what we have looked at is various segments and regions. And it looks like there was a clear unwinding of some momentum trades. So market was clearly rewarding sectors with strong earnings growth, whether it's tech, whether it is financials, or even for that matter, briefly energy outperformed, although it's giving back those gains. But I think from a catch-up point of view, the question is, should we really play the catch-up trade just because they fell, or should we rather continue with the themes that are doing well, where we think whether it is tech or whether it is some of those themes that like utilities have actually held up much better and we still have strong earnings growth. But if I look at more from a mean reversion trade, where we thought there was undue correction was healthcare stocks actually, which generally tend to be a bit more defensive. We thought those corrected for the wrong reasons, and surprisingly, material stocks as well, which generally perform very well. That also actually have unduly corrected. From a region point of view, again, Asia ex Japan, we thought also fell for the wrong reasons. One of our overweight markets. Uh, Again, US actually market has held up much better, showing the return to quality. Whereas, yes, I mean, Europe and other regions fell, but we also thought there's a bit of, mean reversion as well, given the strong momentum. So to summarize, catch-up trades that we like, Asia ex Japan as a region, and from a sector point of view, I think healthcare and materials. But if I have to express our conviction, actually, we still want to continue to position in tech and utilities where not only they held up much better, but they also have the earnings support. And that is the reason why we were actually still pounding the table on those sectors.
Thank you very much, Sandeep. Moving back to you, Manpreet, I recall in I think the last week's weekly update, there were two specific risks that were called out that possibly continue to remain live. One being the intra-Iranian factional conflict that could complicate the strait even post a ceasefire, and the other being Israel's skepticism about any deal that doesn't require Iran to surrender. So, how do you think this could play out, or do these risks remain front and center even now?
No, it's a great question because on one side, while we have the optimism around the ceasefire, the possibility that we get to a deal, I think to your point, there are several risks we need to keep a watch on because the downside risk has not obviously been completely taken off the table, right? So I think you pointed to two examples of risks that we need to ideally avoid occurring over the next 2 weeks because the two examples you cited obviously could derail the ceasefire and then eventually hopefully a long lasting agreement. A third one maybe I'd add to it today is the specific nature of any agreement we get on the Strait of Hormuz and exactly how open that stays to international shipping and in what form exactly. But that comes to where we started the conversation. I think the fact that we got a ceasefire, the fact that negotiators are likely meeting in person in Islamabad is a positive. It points to a high likelihood that the ceasefire translates into a long-lasting agreement in line with the base case scenario. But it does mean, as investors, we shouldn't take our eye off the ball on protecting against some of the downside risks. So again, if you recall last week, the week before, our core message on that base case scenario was not to touch long-term allocations. I mean, Sandeep talked about some of the long-term ideas we like in the equity space. We didn't make any changes to our long-term asset allocation, but we did put some hedges in place against the downside scenario. So yes, the classes like inflation-protected bonds, which actually have done reasonably well over the course of this conflict. Obviously, any kind of oil price correlated assets, such as energy sector equities, and maybe from a longer term perspective, gold. I think those still remain quite valid. Obviously, there's something we'll be watching day to day, especially ones that have done well, whether they warrant taking some profit or holding on. But the broader approach of not touching long-term allocations, but keeping the downside risks in place, we just think that's the best way to balance what we think is the most likely outcome versus the risks that are still out there. That's the balance, the way we would balance it as investors.
Thanks, Manpreet. Sandeep, again, back to you. From an equity market perspective, where do you see the biggest disconnect between fundamentals and pricing today?
Yeah, sure. Actually, I would say the biggest disconnect is in the markets itself, where if I compare with 2022, in 2022, I can understand why markets fell, right? Because earnings have been revised down 5%. What is interesting is that year to date, actually, earnings were not revised down. Earnings were actually revised up by 5%. In fact, if you look at the last 2 to 3 years, I mean, barring what's happening on the geopolitical front, I think when we entered this year, we had one of the cleanest setup from an earnings point of view. And when I look at actually where markets are now, I mean, we're still down year to date. Probably it might change with the markets. I mean, looking at the pre-market returns. But so for me, actually, the biggest disconnect today itself is between the strong earnings growth and where markets, because we're already 3 months into this year. And if you, I mean, go by the run rate, right? I mean, markets should have been up 4 or 5% by now. If you go by historical trends, when you have a double-digit earnings growth and we are still, flat. So for me, that's number one disconnect. I mean, two, I think earlier we talked about, where probably markets, unlike the previous geopolitical escalations, this time around actually punished some of the defensive sectors. I mean, interestingly, growth has outperformed in the last 1 month. Momentum has actually outperformed. One would actually expect, these kind of high beta sectors to come under a bit of pressure. So that is which we highlighted about healthcare. Now, where I would say market, I mean, I know we might be carried away with what we are seeing in today and maybe in the last 3 or 4 days. I think where I would say investors cannot get carried away is the huge volatility in FX is something that might eat into the margins of those companies which haven't hedged. Because I mean, when we started this year, everyone was expecting dollar to depreciate, and now it might have changed. So I think you might see a lot of FX related losses, whether it is translation, transaction. So be prepared for that. Although I don't think markets would really punish companies and usually start to look through. But if you ask me, like, where could some noise come in the upcoming results? It's FX, and of course some of the just because you saw a big crash in oil prices today, I don't think the underlying supply chain issues are being sorted out. It takes a lot of time for the supply to come back beyond just oil. We are talking about natural gas. We are talking about helium. Look, I'm based here in Asia. I can see how tech companies are really worried about helium, which goes into manufacturing of chips. So that is where I think investors should not be complacent. But to conclude, the good news is when we are expecting global earnings to be up 16%, even if there is a bit of noise out there, there is enough cushion or margin at this stage. So let's say, even if there is a 2 to 3% cut, by the way, this is not our base case, but let's say because of FX, because of any commodity prices, if there is a downside, there is enough margin of safety today than in 2022.
Thank you, Sandeep. That's a very good insight. Thank you. I know we do typically get a lot of questions around the inflation and the corresponding Fed's actions. I guess not too much has changed, but a lot has changed as well. So maybe Manpreet, last week markets were pricing a 1% monthly CPI print. Does this change our view on inflation in any way and the course of the Fed's rate cut?
So I would argue that from a trend basis, if we continue to proceed down this base case scenario and the rise in oil prices ultimately proves to be relatively short-lived, then I think on a trend basis, on a full year basis, there should not be any change, right? Because our base case view was for the Fed to stay on hold for the first part of the year, and then cut rates a couple of times in the second half. Mainly because they're focused on some of the softness in the job market, and that we think would bring policy rates closer to neutral and support an extension of economic growth. Now, from an inflation perspective, there's no doubt that even if it's been short-lived, there has been a period of higher oil prices. So we should expect to see some impact on that headline CPI inflation number. We'll most probably see, the coming months, possibly the month-on-month number to increase. We might see, a near-term peak closer to 3%. So an interruption to that long-term gradual downtrend in US inflation, and a similar trend in other major markets. But I think what's important here is going back to what Fed Chair Powell said, right? At the end of the day, if this is likely to be that one-off rise and done, then it's easier for central banks to start to look through it. And for the US, which I think is the one that still matters for most major financial markets, especially our preferred equity and bond markets, that does appear to be the case. The key one is looking at inflation expectations, right? Because no doubt the very short-term inflation expectations are moved higher, as one would expect. But actually, inflation expectations, even a couple of years out, or the key one which central bankers watch is expectations of inflation 5 years' time, they haven't really moved. So if anything, that gives the Fed quite a bit of room to sit back and let this play out. The only caveat is obviously there are some regions like Europe where that rise in inflation expectations, the long-term rise in inflation expectations, is a little bit more significant. So I think that's the reason why from the ECB, we've seen policymakers be a little bit more hawkish. In our view, that will not translate into a tangible rate hike. But our expectation always was the ECB would just stay on hold for the rest of this year. And I think so far, we think that remains a reasonable expectation for the rest of this year.
Thank you, Manpreet. So Sandeep, you've the energy sector, you've, I think, briefly touched upon it, but it's been up over 25% YTD through this conflict, and then now oil is down 19%. The energy trade per se is under serious pressure. I know we called out one of the hedges as the energy sector as well, but is energy still a buy or is it a sell from here on?
Yeah, sure. So, the way we look at energy equities, to be fair, it's really a binary call, right? So if, let's say, we had held this call yesterday, probably I would have said, oh, there is some upside given where oil price assumptions are. And now suddenly you bring down your assumptions by 15%. So the way we look at energy equities, while we have highlighted it as a hedge, so maybe in a risk case scenario, probably it still makes sense to consider it as a hedge. Like similar to how I guess probably Manpreet might have also highlighted many times, right? So your hedges cannot be your core investments. You cannot have 70-80% of your hedges as your main investments. So the way we look at it is that we are not calling it a sell because who knows what will happen in 2 weeks or 3 weeks time. So the reason why we are calling for a more neutral, while acknowledging that probably in the near term, maybe the high beta sectors might do well, and then probably energy might underperform in the very near term. But we're not really calling it as a sell, but more as a neutral. I think one thing we also need to understand is, in the grand scheme of things, energy contributes roughly around 4%, maybe 5% this year to the global earnings. So I think, yes, it might be relevant in one particular region, but if you look at in the grand scheme of things, including the weight of energy companies in an index level, so I think energy constitutes roughly 5% of equities. So maybe that is the right allocation, at least from a global balanced portfolio. So if investors have a massive exposure there, probably I would start to diversify into other sectors. But at the same time, if investors don't have any exposure to energy, probably this is also a good time to gradually build exposure. So that's the reason. Again, it's not a binary call, buy and sell. Right sizing is very important. So 5% of equities is what we think is the right allocation for energy.
Thank you. Thank you so much. Sorry, Manpreet, going back to you again, right? I know we've spoken a fair bit about macro and equities, and we'll come back to it, but just a quick one before I pick up some questions from clients. Which segments within the fixed income space are you most cautious on today? Is it the high yield, the EMD, or even the IG space? And where are you seeing a lot of opportunities in fixed income today?
So I think on the opportunity side, I'd focus on, let's say, 3 areas, right? I think Number one is, one consistent message out of the past few weeks is to focus on locking in the yield on high quality bonds. And to some degree, perhaps regional bonds are a great example of that. They're still very high quality credits, and they're supported by the fact that not only are spreads a little bit wider over treasuries, but actually US government bond yields themselves have crept a little bit higher. And even after today's move, they're still at the higher end of our expected range. So I think locking in that yield, using the opportunity to lock in the yield for those who are seeking income, I think is one clear opportunity. And it links to what we discussed previously around interest rates. The fact that we think the Fed is not in a hurry to now push yields, bond yields even higher, is part of the reason why we'd rather be locking the yield today rather than waiting for higher yields, which we think are unlikely. We think it's more likely than not that bond yields will move lower. So that's on the higher quality side. But after the ceasefire, I think there are two of our long-term overweights, increasing, once again look very attractive as opportunities, particularly that since we're getting better entry points than we did 6 weeks ago. So of those areas, one, of course, is emerging market bonds, both in the dollar and local currency space. I mean, these are, emerging markets bore the brunt of some of the pain, right? Exactly like Asian equities, as Sandeep spoke about. But we do think these are fundamentally, improving credits. We do think local currency bonds should benefit from a gradual turn lower in the dollar, which we've already witnessed today. And that's obviously something we'd want to buy into, particularly as a rebound trade on the fixed income side. And the third one I'd highlight, of course, is US and European high yield bonds. We call developed market high yield bond is really US plus Europe. These are, of course, equity correlated bonds. They are at the riskier end of the spectrum. But the reason we like them is not only the goal of locking in a yield for income. I think it applies equally to high yield as it does for high quality bonds. But more importantly, these are bonds that are sensitive to credit quality. And it's interesting that you look at most measures of aggregate credit quality in the US, which is the largest chunk. If anything, those credit quality metrics are getting better rather than worse. So you put that against the context of hopefully improving risk appetite in a base case scenario. That's a third area that can add into a mix. So quite a few areas to focus on if the goal is to generate a yield and an income. The one area, to your point, which is area to be careful about, of course, is maybe the subset within high quality bonds. One area we just be a little bit careful or cautious about is US investment grade corporates. Not that we're particularly worried. Obviously, our credit quality is really by design very high. So obviously, anything holding to maturity will be fine. But that's the area we're mindful that a lot of the tech companies are starting to fund more and more tech capex through borrowings in the US corporate bond market. These are all high quality issuers, investment grade. But at the end of the day, it's a simple demand supply balance that might push the premium these bonds have to offer over US government bonds a little bit wider to allow for that higher supply. So not really a credit quality worry, but I think more mark to market, we might see some volatility, as that larger supply is priced in. But I think big picture, if you sort of take, what I've spoken about, we just think it's a great time to lock in the yield, for income, whether you're doing it at the high quality end or at the riskier EM or high yield end.
Nice. Thank you so much, Manpreet. We do have a lot of clients who are interested in, locking their yields in this region, so we'll take that away as well. Again, coming back to a question that I'm picking up from the Q&A tab, there's a question on whether we should temporarily pivot away from international equities in energy-dependent regions towards energy-producing markets like Canada, US. In fact, that ties in very well with a question that I already had, which is, I possibly can associate India as one of the most sensitive to oil price as well. And with this latest development, does our conviction on Indian equities now become our highest conviction and a near-term buy in AXJ?
Yeah, sure. Thanks. So there are a couple of questions, right? From energy independence, exposure, like what you mentioned, US, Canada. So I think at least early March, we looked at countries and regions which are from a exposure point of view have the highest exposure to energy, and we also thought materials. So these are basically the two sectors which actually have held up much better in 2022. So if you go by that logic, one would have said, Australia, Canada relatively have more exposure to these two sectors than your other traditional markets. Having said that, I don't think that really worked, except for a brief period of time, because What also happened is, energy might have performed well, but materials was actually the worst performer, so there was a natural hedge. Then the other way, what we also looked at is we looked at what's the percentage of companies within each market that are positively affected and negatively affected, right? So positively affected obviously are energy companies directly, but negatively affected, we looked at both first order and second order effects. By the way, I wouldn't get confused between the GDP impact and the earnings impact, right? So there are, for example, regions where maybe the GDP impact is much more, but when I look at from a index point of view, actually there is kind of manageable, right? I mean, Thailand is a classic example, right? I mean, the macro impact is actually quite limited. But if you see Thailand has a lot of these downstream companies, so maybe from a market point of view, actually Thailand would be still vulnerable. So what I'm trying to say is that yes, India from a macro point of view is one market where definitely there is an impact given it is depending on oil imports. But when we actually look at a sector impact within the benchmark indices, yes, there is definitely more companies exposed on the negative side than the positive side, no doubt. But India is not a standalone. In fact, there are other markets as well. So we have, for example, Philippines. We also have, in grand scheme of things, even Korea and other markets. So the way we look at that, again, investment is not only about you know risk scenarios, and in a risk scenario, no doubt, I think India would have been more vulnerable. But what we also noticed is actually our overweight markets, whether it is US, China, and even India and also Taiwan, actually have held up much better in the last 1 month. Whereas the biggest underperformance actually came from those overheated markets, right? So Korea was an example. We did see Europe actually underperforming, Japan underperforming. So which gives us confidence that probably if during the one of the toughest periods of the time, when India as a market can outperform or at least relatively hold up much better, then it gives us confidence that probably we should continue to. So the way we are positioned in our Asia Japan strategy, I call this offensively defensive strategy. So Taiwan is the market which gives us the it's like a soccer, right? This is like a striker because of the exposure to semiconductors. On the other side, China is a market which is defensive because its valuation is cheap and it has a lot of value companies. So India is somewhere in the middle. It's like midfield. So it has some, companies on the more, cyclical side, but equally there are a lot of consumer companies, and of course, IT has become now a value play in that sense, given what's happening with the AI disruption. So long story short, I think we find the way we are positioned currently, a blend of everything is still consistent with how we would like to position. Same way on the sectors, right? So same way we have technology, we have utilities and healthcare. So you can play the same soccer analogy there as well. Between strikers, midfield, and also what is your defensive. And finally, to conclude on Asia ex Japan, I mean, it did underperform, probably a bit of payback. But the good news is we also started to see it's bouncing back hardly in the last few days, led by, again, North Asian markets, including Korea and also Taiwan, and then India and China, while they also rebounded, but probably less so than the other markets. So overall, I think we remain positive on Asia, Japan, particularly for the global investors who have concentration in the US and Europe. I think it's a good way to diversify. In fact, Asia is the best earnings growth this year. We're talking about 30 or 35% growth versus 16% globally. So that is the reason we still remain positive. But it's not just India, but again, we look at across the spectrum, China, India, and Taiwan. It's how we come up with the positive view.
Thanks, Sandeep. That's extremely informative, right? I mean, we do have a lot of clients who are have been concerned. In fact, Manpreet will attest to it that we've been having a series of questions around the India story, but this is extremely helpful as well. I'm just going to give you both a bit of a break and take a question that is I see is most popular, which is asking about if extreme war situation happens in the Middle East, like a nuclear war, what will happen to our funds, FDs, USD bonds, stocks kept in Standard Chartered UAE? And could we access the funds from other regions like the Stancy Singapore, India, etc.? Now, thank you very much for this question. I'd just like to touch upon the fact that for over 170 years, Standard Chartered has supported clients across Asia, Africa, the Middle East, and beyond, and through many challenging and stable market cycles, right? These times often reinforce the importance of having a trusted partner who understands cross-border wealth needs, but also understands, staying steady and resilient through such situations. As an international bank, we are uniquely positioned through our wealth centers across the UAE, Singapore, Hong Kong, Jersey, and India, of course, to help you manage your wealth across these countries and have access to international opportunities, and through these borders seamlessly. So while this is, of course, a very hypothetical situation, we will, of course, constantly endeavor to be in touch with our clients to inform them of how best to stay connected, and should be able to make arrangements as and when they kind of emerge. We did have a number of queries around where the custody is, etc. And we want to assure you that some of these instruments are, when you invest globally, they're held outside. And we have to take informed decisions as and when regulators come into play, and we will definitely be in touch and stay connected with our clients in these such situations. Maybe next, going on to the other popular questions on the Q&A, I want to just touch upon currencies, and maybe Manpreet, I'll come to you. One of the things that I see in different forms in the questions here is the outlook for the petrodollar BRICS. And also, I think, there's a question around the AED versus euro, which AED is pegged to the dollar, so I'll take that as a dollar versus euro. If you could maybe comment on it together, please. Thank you.
Sure. Maybe let me take them in a slightly different order. I think first up, the dollar, right? Because that's, I think, central in the current environment and central to our own 12-month view. I think the question on the petrodollar, it's a little bit like asking, the questions around de-dollarization, right? Is the dollar being substituted by other competitors, whether it's the renminbi, digital currencies, or any other potential alternative? And the reality is, look, we continue to be a little bit skeptical about that happening, all of a sudden. No doubt this might be a trend that continues to play out over the next few decades, but we think that's a really, really slow-moving ship. And even if you read some of the admittedly unconfirmed reports about, Iran charging ships, it's interesting. The yuan comes up, but so do dollar-linked stable coins. So the dollar is still very much part of all of these conversations. What I think is more immediate for us, of course, what is as investors, rather than thinking several decades out, is looking over the next couple of months. Right? What we've seen, the dollar play its role as a safe haven currency in the current context. But again, in a base case, if we do see tensions easing, if we do see some more longer lasting agreement put in place, then we think dollar weakness will once again resume, because of the interest rates that we just discussed. And that weaker dollar lifts all boats. Most non-dollar currencies should get a little bit stronger. And I think that comes to the point about the euro dollar, because to some degree, if you go back to that question on central banks, if the euro is a little bit more, ECB is a bit more hawkish than the Fed, you can see where the relative interest rates go. But actually, euro dollar is a currency pair. I've always looked at it as a default anti-dollar currency, right? And the euro dollar is the pair most market participants use to express a view on the dollar. So we think a weaker dollar should result in a stronger euro, regardless, unless something significant happens in Europe, of course. And that's why our 12-month view is for euro dollar to move towards 120. I think on BRICS currencies, maybe just last off, obviously fairly different outlooks for each one of them. I think one part is the structural argument, which, as we discussed, we still think the dollar is the key one here, even if you start to see a bit more trade or a bit more commerce happen around the edges in other currencies. But I think on the large sort of key BRICS currencies, I think the renminbi, that's obviously much more policy driven, but we do think policymakers there are obviously dealing with considerably greater deflationary pressures compared to what we're experiencing elsewhere. And I think that, of course, in our view, should keep the renminbi fairly well supported, regardless of which way the dollar goes. And at the other extreme, look, Sandeep talked about Indian equities. I think we saw a similar sort of reaction play out on the Indian rupee as well. But the context here is, look, we've always seen on a trend basis since 1994, the dollar, rupee usually weaken on an average of 2 to 4% against the dollar. Never in a nice straight line. We've had years of stability or years of disproportionately large weakness, and I think we're experiencing some of that. But as we know, if you're thinking about equity investments or any other investments, that's never held total return in dollar terms back, right? Indian equity still done very well in dollar terms, and other fixed yielding investments should obviously yield you that much more in rupee terms. So to us, that's not the core concern, and if anything, disproportionate, rupee weakness in the short term can, of course, be the opportunity if your interest is in other asset classes.
Thank you, Manpreet. It's very useful. I do see a question around our signature CIO funds. So I'm actually going to take the liberty of sharing the performance of the strategies. Just allow me a second to do that. And I hope you can see my screen now. All right, so the question is, can you please share your comments on the signature CIO funds by comparing them with benchmarks given the negative returns? So let me just walk you through how resilient our signature CIO portfolios have been. If you see, despite the conflict in the Middle East, the portfolios have actually held their stead. If you were to actually compare the portfolios to their, with the near term to the 12-month performance window, then, while the near term, of course, will mirror what the markets are suggesting or doing, but in a 12-month horizon, it's still in double-digit positive figures. Now, what this slide basically shows on the left-hand side is we've charted together the income balanced and the growth portfolios, and the performance of the three strategies in different quarters over the last 2 years. And on the right, you'll see a cumulative, returns of the same three strategies, which have done phenomenally well. From a growth perspective, it's done close to 61% from inception. This is all from inception. On the right-hand side, the graph shows from inception. And the balanced portfolio is done about 47%, and the income portfolio is done about 38%. So what I'd like to state over here is, while, of course, we want to chart out our performances and track markets in the short term, in the near term, most portfolios will end up reflecting what's eventually out there in the markets. But if you were to just pull through a little longer term and hold on to your portfolios for longer term, they eventually kind of average out, in the performance in the longer run is usually positive. But maybe I will quickly pause here and see if Manpreet would like to add anything from a CIO strategy perspective around these three strategies. Thank you.
So, no, thanks. I think I just want to reinforce the point Pratibha made, that I think the real strength of these strategies is the ability to keep you invested long run. Because at the end of the day, these are fully invested strategies, and of course, you get pullbacks, as we witnessed most recently, and witnessed, of course, in 2022. But as we've just learned overnight, it's extremely difficult to time those short-term bottoms in markets, right? If anything, many markets gapped higher. So unless you were predicting the future, predicting Trump's mind and buying yesterday, it would have been almost impossible time that unless you were fully invested. That's really the role these play. And I think the point Pratibha made about how most of these portfolios are still delivering double-digit 12-month returns despite the pullback over the past few weeks. I think that just speaks to the strength of staying invested through the long run. And besides that, yes, I'll link it back to what we've been discussing through these webinars about staying invested in diversified strategies. I think that, this is a good example of exactly what we mean. Of course, some of the hedges alongside would have helped buffer those short-term sort of pullbacks. But we think what that allows you to do is, staying invested and adding hedges when there are concerns. that helps both smoothen the journey, but also make sure you stay invested, and not be caught out when you get these sharp rebounds. Let's not forget that, if you go back and look at the long swath of financial market history, it's missing those big up days as the one we just experienced today. That tends to make quite a big difference to long-term returns. So staying invested on these turning points can actually make a big difference to those long-term returns in your portfolios.
Thank you very much, Manpreet. Maybe a quick one over to you, Sandeep. What's the general consensus, if any, on the US economy, GDP growth outlook for the rest of the year, and how will the financial sector slash equities in the US be impacted positively or negatively?
Yeah, sure. So, I mean, in the near term, obviously, we have to look at the impact inflation will have on the economy. I mean, the good news is we do have some parallels between today and in 2021, where I mean, consistent with what Manpreet mentioned, right? Probably, Fed might take the view that inflation is transitory and maybe not too much on the rates front. But we also think that there are a lot of forces out there, not just on commodity pricing. Given how narrow the growth has been, thanks to the spending on data centers, the good news is that seems to be intact given the strong funding growth we saw recently. And then, of course, with midterm elections coming, expect probably a bit more populist measures or announcements coming there. I don't think numbers would change materially, but I guess one needs to also closely follow the near-term inflation measures. But from a more specific sector impact for financials, I think what we can tell is that I think in the last 2 weeks, probably the market's view on financials has slightly changed, because at the beginning of the year, I guess market was somewhat, concerned about the NIM pressure, net interest margin pressure for financials, because rates were expected to come down. So now I guess that headwind at least has diminished. So now I don't think market is really expecting the NIM pressure for financials. On top of that, we looked at historically when there is volatility. I mean, I was also looking at VIX recently. So when VIX goes up, down, actually that's not a pretty bad outcome for the US financials, given particularly those companies with a large equity trading book. And on top of that, it looks like we will have a pretty big equity issuance this year, which might also benefit some of these big banks. So the results will start next week. I mean, expectations are a bit moderate for financials. I mean, it's expected to report around 12% profit growth in the very near term, and maybe maintain the same trend, which I think in the large scheme of things, we also need to understand that this year, the sector with the largest buybacks is not tech, because tech companies are spending on AI capex. So financials is the biggest, I mean, in terms of sector, the biggest sector, both in the US and globally in terms of buybacks. So that is an additional tailwind. So yes, while we are neutral on financials, probably in the very near term, given the diminishing headwinds on the net interest margins and the fact that there is a bit of buyback support. And as we have seen historically, whenever there's a big equity issuance, we think that financials would perform. So if I have to again summarize the question, I think the big US banks start to look interesting. Risk reward has improved. Some of those banks fell for the wrong reasons recently, including concerns around private credit, and we have done a bit of work. Probably most of the big banks are relatively okay. So I think in the near term, we do see some tactical opportunities for the big US financials.
Thank you very much, Sandeep. I did see a question around some of the commodities. So maybe, Manpreet, if I could, pass this to you. Where do you see gold, silver, copper, whatever you cover, right? And Bitcoin, of course, going in the next few months? And do you have any targets for any of them in the 6 months, in the 1 year time frame?
Sure. So I think gold is the one that we do cover to the maximum amount of detail, and it is part of those long-term portfolios and a long-term asset allocation. And we continue to be positive, right? We were overweight going into this, and we continue to be overweight on gold. And there are a couple of reasons for that, right? There's a temptation to look at gold as just a safe haven. Um, Actually, when you look at past equity sell-offs, it doesn't always play that role neatly. You tend to see gold buying you time when in the early stages of an equity sell-off, but sometimes it can fall alongside. I think gold's real value is particularly when you worry about scenarios like stagflation, right? So think about the 1970s where growth was extremely weak, but inflation was extremely high. And I think those are the kind of scenarios where gold can obviously provide a great hedge. But looking outside of that, right, going back to our base scenarios, that might be something we worry about in our downside scenario. But in a base case, the reason we really like gold still, and we think we can, price target there, of course, is up at 57.50. And that of course argues that where we are today has been, while we're in the 4,000s, those levels represent great buying opportunities, because at the end of the day, we think central banks, they continue to be the main driver of gold demand, right? And we saw a bit of a blip because we saw the past 4 to 6 weeks, some central banks actually sell gold as they normally do when they sell a bit of the reserves or when they're selling pressure on their currencies. But the long-term trend we think is rising share of gold in central bank reserves, and we think that trend, of course, remains unchanged. So if anything, if you're looking to add gold, we think gold in the 4,000s, particularly pullbacks towards 4,500, we think are of course an opportunity. Now, the other two commodities are a bit different, and while we don't maintain formal price targets, I think silver is an interesting one because there's always a temptation to say, well, instead of gold, why don't you buy silver? It goes up by much more. It's a higher, more volatile version. Let's not forget on the way down, it goes down by much more than gold as well. I think the fundamental difference, there are two key differences between silver and gold, just purely as a financial market guy, right? One is, of course, it's much more volatile. And of course, we all like that on the way up, but that applies equally on the way down, right? And second is that the nature of demand is a little bit different. So we don't have the central bank demand for silver, at least not yet, but industrial demand is a much bigger factor behind silver. So I think that's why I always say that if the purpose is to buy gold for its characteristics, then buy gold. Silver, of course, can be a potentially more rewarding, but definitely a much riskier, much more volatile trade around it. Last point on copper, I think, is look, there are demand supply, questions that come up from time to time, but I think copper is perhaps the commodity that's most leveraged to global growth. And while that should do all right in our base case scenario where we return to a world of fairly strong growth, we do think that may not result in copper being the most standout asset, especially when you're comparing with asset classes like copper. So like equities. So I think that's sort of where we sit on those. Bitcoin, of course, a bit of a wild card, right? And look, I think in our annual outlook this year, we did add a small 2% allocation to digital currencies. The predominant one, of course, is Bitcoin. We just think that the key driver here may just be the fact that more and more long-term asset allocators like ourselves, slowly start to add a slightly larger allocation. But we do recognize, look, at the end of the day, it is possibly the riskiest asset class out there. We know volatility can be quite significant there, and that's why I treat that more as dipping our toes into it, right? So it's very difficult to come up with price targets for such a volatile asset class. I don't think that's the right way to think about it. I think a good way to think about it is it worth allocating a small amount? We think yes, but we still think keeping that allocation amount small. We have a 2% allocation in our portfolios. That may be the best way to dip our toes a little bit into it, and while managing the volatility risk, which is still very, very real.
Thank you very much, Manpreet. It's very useful. I do see a number of questions around the Signature CIO Islamic Fund's performance, and maybe I can attempt to answer, and I'll dip into Sandeep's help for some parts. So there is a question around how do you see the CIO Islamic Fund's performance with the current crisis, and also in terms of whether Islamic funds are risk rated 3, does that mean it's less volatile with the current crisis, etc. So just to very quickly give you a broad overview, the Islamic income funds and the growth funds as well, they're designed in such a way that they are allocated into level 1 asset allocation, which is largely your cash, bonds, or cash fixed income, equities, and gold. And if you were to look at just the performance, they have turned out positive performance in January and February, and of course mirrored the market sentiment to some extent in March as well. Now, I do, because of the nature of the investments, underlying investments, the instrument has an additional exposure to technology. And we've seen that technology stocks have had a bit of a pullback. And that's where I'd like to draw in Sandeep as well, given that, tech has had or has been a laggard YTD after a very strong 2025. How do you see that going forward? Does the earnings season become a catalyst, to the sector? And I think that I can, bring it back to the CIO funds as well. Thank you, Sandeep.
Yeah, thanks. So I think on tech, actually the biggest underperformance in tech came till mid-Feb. So it's in fact after the recent conflict, actually tech has relatively outperformed. So let's look at what really happened in the first 6 weeks of this year, right? So we started, of course, the peak was in October, and market was worried about funding. Market was worried about, the circular financing, AI bubble, and then came the disruption risk to software. And given software is almost 20% of tech in the benchmark indices, and that kind of dragged down the rest of the the tech sector. What is interesting is that if you look at within tech, our preferred industry within tech is semiconductors. So we have an opportunistic idea there. Guess what? Actually, semiconductors is actually up high single digit. You're talking about almost, when I look at pre-market data, and if I include that, probably semiconductors would be even up double digits year to date. So I think a combination of many factors, including the big correction of 20% plus in software dragged. So maybe then your follow-up question would be, then where do we stand in terms of this big picture views? On the broader funding, in fact, it's quite timely that we are having this question today, because I believe like today is a big inflection point for the tech and the AI theme, not just from risk on, but also we have seen a big progress in the AI models that came in the last 24 hours, including from Anthropic. And then that for us is a key turning point. As far as funding, the recent 122 billion funding by the largest AI company tells you that at least market fears are overdone, and that should ease some of the concerns. So all those investors were worried about AI bubble, circular financing, circular deals, probably at least for the next 18, 24 months, that debate could be put to rest. Doesn't mean that we are not worried. Yes, it's something, we don't want, we want cleaner free cash flow driven growth, but at the same time, we also need to understand that multiples, so from October, tech multiples have come down by almost 25%, to the extent that last week tech was trading at a 7-year low. All the valuations have come up. Still for the sector, which is still growing at almost 30%, where we are valuation, tech is trading only at 10% premium versus S&P 500. So we think that risk reward is improved. And on top of that, we also think that companies are expected to report results, and we are quite upbeat in the very near term. So to conclude, yes, it fell probably for the right reasons on AI bubble and other concerns, but that's behind us. It's a rare view. And now we look forward to the earnings growth. And given where valuations are, I think the risk reward has improved, given that once again, AI has reached an inflection point.
Thank you, Sandeep. That's very useful. I mean, considering the equity sleeve of the Signature CIO has a higher allocation to technology, this hopefully adds perspective to some of the questions coming there as well. I just maybe again, remaining with the tech space, possibly Japan and UK, if you were to talk about it, have shown positive returns. But we remain also overweight on global equities. US equities, of course, have been relative outperformer through this entire conflict. Will the non-US equities start to doing a catch-up kind of a situation, given where things have developed, and where would you expect to see the biggest relative catch-up trade in global equities per se?
Yeah, so maybe again, probably my answer probably to every equity question is right sizing, right? So if you look at the global equities, US is almost 60% roughly. So 60% of global equities is US and 40% includes, Asia is pretty big. Then we have Japan. Then we also have Europe, UK. So the way we look at today, we are overweight on US because we like the risk reward, given that probably US market as the cleanest exposure to AI, also as pretty good pricing power, and which was also something that evident in the last 1.5 month. Now, the rest of the world, which is the 40%, again, we can always argue about de-dollarization and other overarching concepts there, because I guess a lot of investors are worried about concentration in the US because 60% sounds a lot for one market. But at the end of the day, I think right sizing is very important. So from a catch-up point of view, if I take a very short-term view, as I highlighted earlier, Asia ex-Japan is our overweight market. It fell for the wrong reasons because there's a bit of correction that happened in the North Asian markets, and that has affected Asia indirectly. But we are starting to see that reverse in the last 2-3 days. We still think that Asia offers the best growth outside the US, and again, this gives out the combination, right? Where Asia is a bit more, again, using the same soccer analogy, right? So Asia is for high beta exposure, and US is my, again, given 60%, US is both my midfield and also my defenders because it's such a big market. So we play this overweight markets through Asia, which is my aggressive market, and then US, given its scale, offers both defensive and also pretty good compounding companies. Japan, Europe, again, we did upgrade Japan. We took advantage of the recent correction and it fell. So we did close our underweight position. And that it is probably a very complex market, and we rather look for specific niche themes there. Whereas we are cautious on Europe. I know many investors might think that Europe is cheap, but you need to also understand that while Europe at 15 times forward PE versus US at 21 times, it appears like cheap. But when you do a sector adjusted PE, actually, there's not a big difference between US PE and Europe PE because US has 45% of exposure to tech, which generally has higher PE, whereas Europe has only 13% exposure to tech. So a lot of this so-called cheap valuation for Europe is actually by design. So Europe valuation or US premium versus Europe is not a bug, it's a feature.
Thank you. Nicely put. Thanks, Sandeep. Back to you, Manpreet. I have a question around the CNH. CNH has been more resilient to USD, including from a performance standpoint. What can be behind this resilience? And also maybe I'll flub it to a question that I see here around, again, the euro and the GBP. And the question is, will the dollar continue its appreciation against these currencies going forward in the short term, in the next 2-3 months?
Sure. I think maybe on the second question first, in our view, the answer is no. I think if you look at the dollar, where we've seen the most appreciation has really been in the past 6 weeks. But outside of that, it's really been more of a story of trend dollar weakness, let's say over the past 12 to 15 months. And we actually expect on a full year basis, the dollar will continue to trend lower. I think the dollar strength is more a question to say, look, do we think that safe haven demand, in our view, that's really what drove the rebound of the past 6 weeks. But it's interesting, even that stopped pretty quickly at a key level, 100 on the dollar index, and didn't really break above that. So linking back to our scenarios, base case, as long as we don't see that downside scenario play out, then we think there's plenty of room for that dollar weakness to resume against most major non-dollar currencies. And we think both the euro and sterling will benefit from that. I think the sterling perhaps a little bit less so, more because they have greater growth challenges, which might arguably need easier monetary policy in the UK compared to what we see in Europe, where, if anything, the central bank seems a bit more concerned about inflation. Now, against that sort of dollar backdrop, obviously, like you said, CNH is quite interesting. It's obviously followed a very different pathway. I will point out it's not completely delinked to the dollar. I think a lot of, if you take the perspective of the last 6 to 9 months, actually dollar weakness has helped quite a bit in terms of CNH strength. But there's no doubt that there are 2 or 3 additional factors at play. I think one is, it has been argued that the CNH is perhaps a little bit more on the inexpensive side. So all things considered, it's more biased to get stronger rather than weaker. And I think that you can see perhaps more sharply in the debate around external balances and the large trade surpluses and China's own efforts to try and rebalance that towards greater domestic consumption. Second, and I guess linked to that is, it is a more policy managed currency, and at least day to day, to some degree, that's why we've seen volatility reduce. The third point, I think, is the interesting one, because unlike many other parts of the world where inflation numbers were still a little bit on the higher side, China's arguably faced greater deflation pressures, right? We had headline CPI, producer prices briefly dip below 0. And the thing is, at face value, you might argue, okay, that should lead to a weaker currency. But actually, when you think through the lens of real interest rates, in other words, bond yields, but adjusted for inflation, you end up with pretty high real interest rates because the bond yield might be quite low, but actually inflation is so much lower compared to other major economies. On an inflation adjusted basis, you end up with a higher interest rate than what policymakers would like. So similar to what we experienced with the dollar during the 0 interest rate days, or today with currencies like the Swiss franc, which face a similar challenge. And I think when you put it all together, that, to my mind, explains why we've seen the CNH to be relatively resilient. And we expect it to stay in that way, right? We're not expecting dramatic strength, but we do think a move towards 680 to 675 in a world of dollar weakness. That seems reasonable to our mind of flat to moderately stronger currency.
Great. Thank you, Manpreet. I do notice that we're already past the hour. It was an extremely engaging conversation, and thank you so very much to both Manpreet and Sandeep for all your insights today. And to all our listeners and viewers for your questions and for the time that you've taken to spend with us. I do hope that you found this session useful, and we look forward to continue having this conversation. I also noticed there were a number of questions around individual securities. I would urge all of you to please reach out to your relationship managers and to your investment advisors who could possibly guide you around those in specificity to your particular portfolios. But as this situation evolves, we'll continue to monitor developments closely and bring you our latest, thinking. But if today's conversation was useful, then please do reach out to your RMs and IAs who will help you construct your portfolios or rebalance your portfolios as well. So thank you. With that, we'll close the session for today. Thank you very much. Thanks, Manpreet and Sandeep as well. Thank you. Bye-bye.
Thank you.